Hey everyone, welcome back to Corporate Decoder, the place where we decode the fine print and figure out what it really means for the companies you care about. Today we're looking at Ares Capital Corporation and their latest report, which has some pretty big news about new debt. Stick around to find out what this means for the company and for investors. Before we dive in, if you love getting these straight to the point financial breakdowns and avoiding all the corporate jargon, hit that subscribe button. And if you want to connect with fellow finance enthusiasts and get more exclusive content, join our Discord community linked right below in the description. Alright, we're looking at a Form 8K filing from Ares Capital Corporation. Now, typically an 8K is for big important news that the market needs to know about quickly. And in this case, it is all about a material definitive agreement, which is just a fancy way of saying they signed a significant contract. What they've done here is entered into a fifth supplemental indenture to an existing agreement. Think of it like adding a new chapter to a rule book for borrowing money. This new chapter is all about issuing new debt, and specifically they are raising $750 million by selling notes which are essentially loans from investors to the company. These notes are going to mature in 2031, which is quite a ways off. The interest rate on these notes is 5.250%, which is the cost of borrowing this money. They will pay this interest twice a year. Now, this isn't a small amount of money, $750 million. This is a significant chunk of capital. So what are they doing with all this borrowed money? Well, they say they plan to use it to pay off existing debts under their credit facilities. This often means they are refinancing their debt, perhaps to get a better interest rate or to extend their repayment timelines. They also mention they might reborrow under these facilities for general corporate purposes, which includes investing in their portfolio companies. This is pretty standard stuff for a company like Ares Capital, which is a business development company focused on lending to and investing in other businesses. Now, when companies take on debt, they have to promise certain things to the lenders. These promises are called covenants. This filing mentions covenants that require Ares Capital to follow specific rules under the Investment Company Act of 1940. This act is designed to regulate investment companies and ensure they operate fairly for investors. They also need to provide financial information to the note holders and the trustee if they ever stop reporting to the Securities and Exchange Commission. This is a protective measure for the lenders. There is also a clause about a change of control repurchase event. This means if the company undergoes a significant change like a takeover and the notes get a bad credit rating from major agencies like Fitch, Moody's and S&P, then Ares Capital would have to offer to buy back these notes at their full value plus any owed interest. This is another layer of protection for the investors holding these notes. The actual deal. The closing of this debt issuance happened on the 12th of January of 2026. Moving on to the exhibit section, which is essentially a list of all the important documents related to this deal. We see a lot of legal paperwork here. There is the purchase agreement, which is the contract for buying and selling these notes. It lists all the underwriters involved, which are the banks that help sell the notes to investors. And of course the fifth supplemental indenture itself along with the form of the notes. These are the core documents spelling out all the terms and conditions of this new debt. Finally, we have the signatures. This section confirms that the company officially authorized this report and the actions taken. Scott C. Lem, the Chief Financial Officer and Treasurer, has signed it. Now let's talk about what this all means. Ares Capital Corporation is essentially taking on more debt. On the surface, this might sound risky, but for a company whose business model is about lending and investing, it is also how they fuel their growth. They are raising a substantial $750 million and replacing existing debt with it. The key here is to watch if they can effectively use this capital to generate returns greater than the cost of this new debt. If they can invest wisely and make more than 5.250% on the money they borrow, then this is a smart move. However, the risk always lies in the execution. If their investments falter or the market conditions change unfavorably, they could be stuck with significant interest payments that eat into their profits. They are also hedged with an interest rate swap, which means they are paying a floating rate based on SOFR plus a spread while receiving a fixed rate. This can protect them if interest rates spike, but also means they miss out if rates fall significantly. Overall, this move shows a clear strategy to manage their funding and potentially expand their lending capacity. The company's direction seems to be focused on leveraging their financial structure to drive investment returns. The main opportunity is their ability to maintain profitability on their investments despite the cost of capital. The most notable risk is the general economic uncertainty and the performance of their underlying investments, which could impact their ability to service this new debt. Alright, that is our breakdown of Ares Capital Corporation's latest filing. What is your take on these new debt arrangements, and what do they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives. And don't forget to check out the Discord community in the description for more great discussions. Thanks for watching, and we'll see you next time.